Software stocks have been under pressure this year amid fears of AI disruption, but are those concerns justified? Joining us now to discuss is Chen, VP for Portfolio Research with TD Asset Management. Great to have you back on the show.
Thanks, Greg.
Let's talk about these software stocks. It's been an interesting space indeed, and they have felt the pressure of the fears of this disruption. Pretty tough start to the year. What exactly is going on here?
Yeah, it's been really tough. Some of the stocks were down on the trough of 40%. They've since come back to down 20%, but it's still not looking that good. So I'm going to paint you a picture here. So imagine your favorite restaurant 5-10 years ago. It was hot when it opened. The food was really good. The specials were really interesting. It was really novel. But 5 years later, 10 years later, what's happened? Well, maybe they've gotten a bit lazy, gotten a bit tired, cutting corners here and there. The features are tired and old. And that's kind of what's happening to some of these software stocks and the software itself. So in November, Anthropic, a big AI lab, released this piece of technology called Claude Opus 4.5. And what this is an LLM, but it's also a coding tool. And the coding tool is really quite good. So imagine the coding tools before as an apprentice for building a table. You have to specify what color you want, what finish, the dimensions, all of that. But this Claude Opus 4.5 is a master craftsman. You say where you want to put it, it looks at all your furniture, looks at your preferences, asks you the right questions, and you get the best of the best, and it's exactly what you wanted and you didn't even know. So now we have this for code. And this really scared a lot of people because these software companies are code. So if someone can just point to something and say, hey, make me that and make it good, then what is the moat of these software companies? And that's kind of why we had this big drawdown from last year into the beginning of this year.
So let's put a framework around that in terms of what is going on and the historical precedents. How do you start to organize this information?
So this isn't the first time that software companies have gone through a transition. There's three main areas that software has had to evolve from. So the very first was the first iteration of software, and this was on-premises software. So back in the day, you didn't have the cloud, you didn't have a cell phone. What you had was a computer shoved in a closet somewhere that was running your ERP, it was running Word, and it didn't really update. It took a long time to install. You had to have people come on, and you didn't get an update. You had to buy maybe a disk and install it on your computer.
I'm thinking about my disk full of floppy drawers, a drawer full of floppy disks back in the day.
Exactly. You have to keep them just in case something happened to your computer so you could install in the new one. So that was an interesting time of software because you had these really sticky businesses, but not much pricing power on the back end. Then comes SaaS. So this was the golden age of software, the 2010s to 2020. And this was a shift. So now you had distributed computing, and you could deliver software through a website, through the cloud, and it made updates really, really quick. So if I had a customer who wanted a feature or a bug fix, they could tell me, and then I could deliver it, and I'd be happy for that. The customer would be happy for it. They would pay, and you get this nice cycle of pricing increases with features increases, and it's a virtuous cycle. I think we're coming to the end of that period with AI. And this new phase is what we call the enabled or agent phase of software. This is where you might have an agent working for you. And what that basically is a piece of software where you tell it to do something without explicit instructions. It'll ask you questions. It'll know kind of your intent and what you want it to do, and it'll go and do it. So in this phase, human work looks quite different. We don't know quite how it's going to work out, but we see something on the horizon. We see a shape of it, and investors are just wondering how that's going to evolve.
Another thing they might be wondering is, are these software stocks ever going to come back? What's the big threat here?
Yeah, there's a couple things to parse out here. So I want to talk about the threat to these software companies and then maybe the ones that might do well in the back end. So the first threat, I think, is if you think of any business, it's price times quantity, right? You want to sell more things and you want to charge more for what you're providing. So quantity was a big tailwind from the 2010s to 2020s because we just had this new technology. We didn't have all these incumbent technology players, and you could just grow into an organization. If you had a small organization who wanted Salesforce or Microsoft, they didn't have all of that. So you could just grow time and time and time again, year after year, just adding more seats and adding more people. I think that's likely to stop as, number one, hiring is not so great right now, and people are doing more with less. So a lot of these technology companies are laying off people or using AI to supplement people. So the seats, the queue part of that equation is going down. On the pricing side, we talked about that virtuous cycle of features and pricing going up. And now I think that's also in trouble because AI can do what the features of the software company would have done. So at the edges, your core business of AI, of your software, is doing okay. It's chugging along, it's really sticky. No one's ever ripping out Microsoft Word, no one's ripping out Salesforce. But the edges and the features, the analytics, or the nice to haves, maybe that starts to be done in-house. Maybe the AI is doing it. Maybe you're taking a picture on your screen and saying, can you just analyze this chart for me? So I think it's going to be harder and harder to push through pricing, and those negotiations are going to look quite different 2-3 years down the line. Finally, changing how we work. So we had that coding assistant who knew your intent and delivered quite a good product. Well, they changed that to work for white-collar labor with no coding. So they called it Claude Co-work. Now Microsoft has Copilot Co-work as well. And basically you give it a task like you would an assistant. It'll go out and do it. It'll ask you for your verification. And it'll make your life a little bit easier in the workplace. So we don't know how this is going to evolve, but all we know is something's going to change. And that's kind of bad for incumbents. So what companies are going to do well in the future and at the end of this? Well, I think a lot of companies maybe aren't going to recover to where they were before. Valuations were quite high. Investors were overweight these stocks for many, many years because of the attractive features we talked about. But the companies that will do well are embedded in the organization and have a monopoly, or they're horizontal in nature, which means they touch multiple parts of the business, or they're mandated by legislation or by some external force or non-economic buying. So I'll give you a couple examples. Microsoft is a horizontal type software where you use Word, I use Word, everyone uses Word, everyone uses Outlook. I think that'll be okay for now. SAP is an ERP software. A lot of these auto industries, manufacturing businesses run their entire business on it. You can't rip it out. It's very tough. They have good data, and the business uses their software often. I think that might be okay coming out. On the other side of that is security. So with AI, it's easier for threat actors to try to hack you, send really realistic phishing emails, and you need security against that. So I think security software like Palo Alto, like CrowdStrike, these will do okay on the other side, as you can't really skimp on security if the threat environment is getting worse.
Now, if we were having this conversation just 3 weeks ago, we would be talking about the major source of angst, for the most part, in equity markets. Of course, things have changed pretty dramatically with the conflict in the Middle East. Is there anything about that conflict right now that's changing the narrative around artificial intelligence?
You know, it's interesting. I think the stocks that have to do with AI are holding up better than the rest of the market. And there's a couple reasons why. But I think the first one is that the people supporting this AI push, or the money behind it, it's the biggest companies in the world, right? It's Microsoft, it's Amazon, it's Google, it's Meta, and they have the cash flow no matter what happens around the world. People are still viewing ads, people are still using Microsoft Word, people are still buying packages on Amazon. They have the cash flow to continue the spending despite what the economy looks like. So that's one good part of the AI trade, is that the people funding it have enough money. I think what's interesting is the funding for the lower players, or maybe the not as well-funded players. In the Middle East, there's a lot of money there. They have sovereign wealth funds, and they're a big part of the funding for some of the smaller players here. So if they're distracted, if they're busy, they don't want to sign deals, then it could lead to funding on the bottom end drying up or getting delayed, which would be a negative for the space. And then finally, we heard news articles that there are bombings of data centers in the Middle East. So, NVIDIA chips are better than gold, basically. So it's pretty bad if, we have a data center blow up owned by Microsoft or Amazon out there in the Middle East.